Hello traders, so in this video we are going to look at fair value gaps into detail, right? So we'll be covering everything that you need to know about fair value gaps. We'll be looking at why they are formed, how to take trades of them, and also at the end of the video I'll be sharing two important secrets or things you need to know about trading fair value gaps, right? So do well to follow through and try not to skip through this video so that at the end you'll be able to catch trades like this one. Now let's get started. So fair value gaps, also referred to as imbalances or liquidity voids or inefficiencies in the market. You can call it whatever you want to. They are mostly formed as a result of imbalance of orders in the market, right? So when a particular exchange receives one particular order over the next, right? So maybe too many buys than sells in the market. And anytime these gaps are formed, we find that price tends to move back to fill these gaps before continuing in its direction. So with this sketch, this is what a fair value gap will look like, right? So consisting of three different candles, right? So it doesn't matter whether they are buy or sell candles. And then you find this gap between them. So this is the void that we are talking about here. Right, so from the wick of this upper candle and then the wick of this candle as well, this gap is what we call the fair value gap, right? So you can use this tool. This is the tool I used to draw the parallel channel, but you can use the box tool as well. So this is what a fair value gap is. Now mostly anytime this is formed on the market, we find that price tends to draw back into it before continuing to move in the same direction, right, or continuing the trend, right? So one thing you can quickly note is that fair value gaps are mostly valid fair value gaps are mostly formed after you have order blocks, right? So if you know what order blocks are, you know that right after an order block, when there is a fair value gap formed, it's mostly a valid one. So in case you don't know what order blocks are, I've made a separate video on that. I'll have it linked in the description. These three candles here, we find a gap formed in between, right? You don't find any of those gaps formed here. So we find that next time price tap into this gap, gives us a huge buy, right? So now that we have identified what fair value gaps are, let's now look at how we can actually trade them, right? So after identifying and drawing out your fair value gap, now it depends on the type of imbalance or gap that it is, right? For instance, this is a bearish imbalance, so we are only looking for sells, right? I'm going to put in my sell position right here. Now your entry, depending on the volume in the market at that current time, you can have your entry just at the low of the gap or also at the premium of the fair value gap, right? Or even at the equilibrium, right? Either ways, you get into the trade once price taps into that fair value gap, and then your stop loss can just be a little bit above it. Now your take profit should mostly be targeting the previous swing low, just as I've done, to give us a good 1:6 risk to reward, right? So right below you can find another reversal fair value gap, and we find that price draws back into it before continuing the trend upwards, right? So these things are all over on the charts. Once you train your eyes, you can easily spot them. Now a lot of things goes into it, right? You don't just take trade solely off fair value gaps, although you can still do that, but in order to have the best trades as possible and try to minimize your losses, there are some other confluences that you can add to improve the overall quality of your entry. So just as I mentioned earlier, one of the secrets to know is that if a good fair value gap is mostly formed after an order block, right? So that is one thing to know. Another thing to identify whether or not a fair value gap would actually react is when you find relative equal highs or lows, basically liquidity, right? So ICT teaches that anytime you find relative equal highs or lows, just like I have here, residing below these lows are buy stops, and then residing above relative equal highs are sell stops. So basically buyers, those who intend to buy in this market, will have their stop loss right below that area. So you find that price comes and takes or sweeps that liquidity which also means money, right, before continues to move. So normally market does this in order to get more fuel. So those who have their stop losses below these two highs right here are going to get taken out before the market continues to move in their direction, right? So with this knowledge, once you identify a fair value gap below or above relative equal highs, which we say resting above that is liquidity, right? So when you find a fair value gap just above relative equal highs, you should know that price is likely, very likely, to go and take that liquidity to rebalance orders in the market. So to sum it all up, we have looked at what fair value gaps are, why they are formed, and how to take trades of them, and also two important things to note before taking trades. So that will be all for this video. Make sure to like and subscribe to get more content like this. This is just one of the many videos from the new series, How to Learn ICT Concepts as a Beginner Trader. So you can check that out, and I'll see you in the next one.